basically good to set the scene where we're talking about at the moment. And what I wanted to start off with is just simply look at the implications of an unprecedented year in which COVID-19 has really impacted economic growth. So what we see here is basically a real GDP index, which starts in 2019 Q4, when we were pre-COVID and nothing was seemingly on the horizon. And what we see here is just 4 countries in the Eurozone on average. And what I want to do is really put the Netherlands in perspective of a wider European context here. And the Netherlands is the light blue line, which has in 2020 Q2 the less impacted by COVID. And this is pretty much correlated with the response by the government to the pandemic. Because if we look back and compare the current crisis with the GFC, we see that government policies have been much more quickly to adapt policies that help the economy going forward. But if we then look to 2020 Q4, the Dutch economy is still closer to its 2019 Q4 levels than the other countries. And by the end of 21, it's only Germany that is going to be ahead of the Netherlands. So there's, of course, a dramatic impact from COVID-19. But if you compare it in the European landscape, the Dutch impact is more or less less severely impacted by COVID. And if we then go to the next slides, we really want to pin it down on, okay, what has this unprecedented COVID-19 pandemic done to the investment market in real estate? And this is data from our friends at RCA. If we just look here to the 2020 volumes, we really see that the volumes are significantly down from 2019. But we also have to keep in mind that 2019 was a very good historic year for the investment markets. And if we then drip it down to the different sectors, we, for example, see that predominantly offices has been impacted much more than, for example, the resi or the logistics markets. So let me go to the prime yields. The investment market is down, but very strong tailwind sectors like logistics and resi are continuing to attract lots of investors' appetite. And that's basically what we see back in this chart as well. And this is data from CBRE, which shows the property sector's prime yields evolution over time. And where I would really like to focus on are like the last 6 quarters of this graph, where we can really see a bifurcation. At the one hand, we see shopping centers and shops. Again, this is prime data, which are more or less widening out, where the widening of shopping centers is, of course, a little bit more dramatic because it goes to 6% from below 5% pre-COVID. But this bifurcation, we really see that logistics, and that's going to be very interesting going forward as well, is attracting loads of investments, and this is driving yields down. And here we see, based on the data, that yields are around 3.5%. But also for the residential market, we see that yields are coming down, and that is again in line with the investment volumes that we saw. So all in all, we see a bifurcation, but the question then is real estate expensive? And on an absolute value, I would say probably yes, because yields are very low. However, if we put it in a multi-asset perspective and we compare property yields with yields from, let's say, fixed income or dividend yields from the equity markets, real estate is very attractive because the spreads, and with the spread, I mean the difference between property yields and, for example, government bond yields, is around historic highs. So that makes that real estate is pretty attractive. And this is our AEW in-house risk-adjusted return. And let me explain it quickly. In our risk-adjusted return, we look at all our different market segments across Europe. So we have data for high street, light industrial, logistics, offices, and shopping centers for a wide range of markets. And in Europe, we have this for 100 markets, for which we have our expected rate of returns, which is on the y-axis, which is basically what is the total return we expect for the next 5 years from a certain market. And then we also calculate our own required rate of return. So what does an investor need to get to be compensated to invest in a certain market? And if we then display this on a scatter graph, we can really see which markets are attractive on a risk-adjusted basis. And here I wanted to emphasize the strength of the Dutch market on a relative basis compared to the rest of Europe, where we see quite a lot of markets in Europe on the left-hand side of the neutral line. And the neutral line is the black line in the middle, which basically represents the point where the required rate of return is equal to the expected rate of return. Where we can say, okay, if the expected rate of return is higher, then a market becomes attractive on a risk-adjusted basis. So we see, for example, Rotterdam, Amsterdam, logistics being on top of our list in terms of risk-adjusted returns. We also still see on a relative basis good value in, for example, Utrecht and Amsterdam offices. On the other hand, and not unsurprisingly with what we just highlighted before with the yield movement in retail and in the investment volumes, is that retail is struggling, albeit it's better than we have seen before. And this is mainly due to the repricing that we have seen in the markets. If you want to know more about our risk-adjusted return framework, we have a European one, which is published on our own website, but we also have a global risk-adjusted return, which puts the markets into context and is really a conversation starter.